You don't lose money when the market crashes. You lose it when you wait. That sounds dramatic. It's not. It's subtle, quiet, almost polite. Most people don't wake up and say, "I'm choosing to sabotage my financial future." They say something way more reasonable. "I'll start investing when I make more. I'll wait until things calm down. I just need to feel more ready." Sounds responsible, yeah? Sensible, mature, very adult. But here's the uncomfortable truth. Waiting feels safe, and that's exactly why it's expensive. Not expensive in a loud credit card debt way. Expensive in a compounding invisible opportunity cost way. And if you're in your 20s right now, ambitious, a bit anxious trying to get your footing, this is the one mistake that can quietly set your financial ceiling lower than it needs to be. Because the real cost of waiting, it doesn't show up on your bank statement. It shows up in the life you don't get later. And most people don't realize that until it's a bit late. So let's talk about what's actually happening when you delay investing. And why this gets worse the longer you ignore it. 1. I'll start when I have more. Picture this. You're 24, maybe 27, you've got a job. You're covering rent. Groceries are wild. Everything's more expensive than it should be. You're not broke, but you're not exactly chilling either. So you tell yourself, "I'll invest when I'm making real money." Fair, logical, very Swiss of you. Precise, cautious, calculated. But here's the kicker. Investing isn't about how much you put in at first. It's about how long it stays in. Compounding doesn't care about your feelings. It cares about time. Let's pause for a second. If you invest $500 a month starting at 22 versus starting at 32, the difference isn't 10 years of contributions. It's potentially hundreds of thousands in long-term wealth, without you working harder. That's not hustle culture talk. That's math doing its thing. And yet most people delay not because they can't invest, but because they think it won't matter yet. That's the mental trap. We overestimate how much income matters at the beginning and underestimate how much time matters. Quick question. If you had the choice between A, earning slightly more next year, B, owning more productive assets for the next 40 years, which one actually builds freedom? Be honest, because here's where this gets uncomfortable. If you're spending $300, $600 a month on lifestyle upgrades but telling yourself you can't afford to invest $200, this might be about priorities, not income. Yeah, I know. That one stings a bit. But don't bail yet. It gets deeper. Because waiting isn't just a math problem. It's an identity problem. 2 waiting trains. You to be a consumer, not an owner. Nobody plans to stay on the consumption treadmill, but delaying investing keeps you there longer. When you don't own assets, broad market ETFs, index funds, productive businesses, you're essentially renting the economy. You work, you get paid. You spend, repeat. It feels normal. Everyone around you is doing it. Your mates are upgrading apartments. Your coworkers are financing cars. Your feed is full of holidays in Dubai, London, Sydney, vibes immaculate. And you think, "I'll invest once I've enjoyed life a bit." But here's the dry, slightly British reality. If all your money goes toward consumption in your 20s, your 30s get more expensive because lifestyle locks in. Once the nice apartment becomes normal, it's not a luxury anymore. It's the baseline. Once the upgraded car feels standard, downgrading feels like losing. Waiting to invest doesn't freeze your life in place. It lets your lifestyle inflate while your assets stay flat. That's a dangerous combo. You know what's powerful? Being 30 and having options. You know what's stressful? Being 30 and realizing you've built a great lifestyle, but no leverage. Pause. If your income stopped tomorrow, what would keep paying you? Silence there is data. This isn't about being extreme or never enjoying yourself. We're not doing monk mode. It's about balance and ownership. Because when you invest early, even modestly, something shifts. You stop being just a participant in the economy. You become a stakeholder, and that changes how you think. But here's where most people get it wrong next. They wait for certainty. I'll invest when the market feels safe. Let's be honest. Markets feel weird sometimes. Headlines are chaotic. Recession talk. Election noise. Rate hikes, rate cuts. Tech booms. Tech crashes. So you think, "I'll just wait until things settle." Mate, when has that ever happened? There is no decade in history that felt calm in real time. When markets dip, people wait for clarity. When markets rise, people wait for a pullback. So they sit in cash. Or worse, they slowly increase lifestyle instead. Here's the Norwegian-style blunt truth. Waiting for perfect timing is often just fear dressed up as strategy. Now, I'm not saying dump your entire net worth into the market tomorrow. I'm saying this. Long-term wealth is built by systems, not predictions. automatic investing, broad diversification, low-cost index funds, consistent contributions. Not vibes, and here's something that doesn't get talked about enough. When you delay investing because you're afraid of short-term volatility, you're accepting a guaranteed long-term loss in purchasing power. Inflation doesn't wait for your confidence. Opportunity cost doesn't care if you meant to start next year. Every year you sit out is a year your money could have been compounding. Reinvesting dividends, capturing growth, building momentum. Momentum is everything in investing. And the earlier you start, the less you have to force it later. Which leads to the part most people don't want to hear. 4. The future version of you is doing the math. Fast forward. You're 35, maybe 40. You're smart. You've done all right. Income's better. Life's fuller. Then one day you plug numbers into a retirement calculator, and you realize something slightly uncomfortable. If you'd started investing 10 years earlier, even small amounts, you'd be in a completely different position. Not because you were irresponsible, but because you waited. This is the mid-video discomfort moment. This might be about you. If you're currently telling yourself, I'll start next year. I just need one more raise. I'm still young. You are. That's the point. Compounding rewards the early, not the intense. The person who invests $300 a month for 30 years often ends up ahead of the person who invests $1,000 a month for 15. Not because they're smarter, because they respected time, and time is the only asset you can't earn back. Let that sit for a second. Most people think wealth comes from grinding harder. Often it comes from starting earlier. So the hidden cost of waiting. It's not market losses. It's lost decades of quiet growth. And here's where we shift. Because this isn't about fear. It's about control. Waiting to invest feels safe because it keeps you comfortable today. But real financial security isn't built on comfort. It's built on systems. You don't need to predict the next big stock. You don't need to be a finance nerd. You need 3 things. Time, consistency, ownership. That's it. When you automate investments into diversified ETFs, when you treat investing like a non-negotiable bill, when you focus on decades, not headlines, you reduce anxiety, you gain control. You stop wondering if you'll figure it out later, because you already started. Here's the calm, slightly Aussie truth. The goal isn't to be rich next year. It's to be unbothered later. Unbothered by layoffs, unbothered by rent increases, unbothered by market noise. And that unbothered energy, it comes from assets quietly working in the background while you live your life. You don't have to go extreme. You just have to stop waiting. Start before you feel ready. Start before it's perfect. Start small, but start automatic. Because compounding doesn't need big numbers. It needs time in the market. And if this conversation made you slightly uncomfortable, good. That means you're thinking differently. The next logical step isn't some crazy stock pick. It's understanding how your current lifestyle decisions are shaping your long-term ceiling. Because investing late is often a symptom. The deeper issue, the way your lifestyle quietly expands to consume your future freedom. And that's exactly what I break down in the next video. If you care about long-term wealth, not hype, not quick wins, watch your lifestyle as quietly setting your ceiling. It connects everything we just talked about. Because waiting to invest is one piece. Lifestyle inflation is the trap that locks it in. I'll see you there.